A crucially important principle investors need to understand is market efficiency. It was first devised by the economist Eugene Fama and helped to earn him a Nobel Prize. But what exactly does it mean? Mark Higgins is a financial historian.
Market efficiency essentially means that prices of securities, such as stocks that are traded on exchanges and bonds, generally reflect all information that is available to the public. And from a practical perspective, this means that there are very few investors that can beat the market by identifying mispriced securities, because the constant buying and selling really makes the price, as accurate as it can be given all information available.
Simply put, market efficiency means that it's very hard to identify in advance stocks and funds that will outperform. Investors should focus instead on simply capturing the return of the broader market.
I think a lot of people think of market efficiency as being a relatively recent phenomenon because it wasn't really described mathematically until 1970 by Eugene Fama. But the reality is that market efficiency existed for a very long time because it's really a fundamental principle of markets. It's ultimately a product of an enduring mathematical principle. It's known as the wisdom of the crowds. It was a concept that was first documented by Francis Galton in 1907. But even before Galton, the principles of market efficiency were actually known to they were called stock operators on Wall Street as far back as the mid 1800s. They knew it was very hard to profit, if not impossible, to profit from just analyzing securities, which is why, and I talk about this in the book, they made a lot of their money by engaging in things like market manipulation and insider trading.
As Mark Higgins says, it's very difficult to beat the wisdom of the crowd. And remember, you're not just up against other ordinary investors. You're also competing with an asset management industry that has grown hugely in recent decades and continues to do so.
Globally, active managers have about 115 trillion, and it's projected to grow to almost 150 trillion by 2027. So even though the evidence is overwhelming that most investors do not benefit from active management, it continues to grow. Index fund investing is growing, but active management, and maybe it slowed down active management a little, but it's still an enormous industry.
In summary, the financial markets do an excellent job of absorbing all the very latest information about the value of different securities. Yes, you could try to beat the stock market, but in the long run, the odds are stacked against you.